trying to understand the stock market, well, it can feel like you're decoding some ancient text sometimes, right?
Totally. You want the real story, but there's just so much data.
Exactly. And you wonder, how do I cut through all that noise and just get, the important stuff? That's what this deep dive is all about.
Yeah, we're here to sort of guide you through it, do the heavy lifting on the analysis.
Today we're diving into Riot Platforms. That's ticker RIOT. Now, they're a big name in North American Bitcoin mining, but they're also branching out. Things like engineering and even infrastructure for AI and high-performance computing.
Quite the evolution.
Yeah. And as of today, May 19th, 2025, the stock's trading around, let's see, $9.15.
And the way we're tackling this, it's inspired by value investing. We're digging into the business itself, the leadership, financials, the whole picture to understand its potential value.
We've gathered a bunch of sources, reports, articles, you name it. They're all linked down in the description if you want to go deeper yourself.
Our goal here, to pull out the really key insights on Riot, what they do, the hurdles they face, where the opportunities might lie.
And hopefully make it, engaging and not feel like homework. Okay, let's jump in.
So let's start right at the beginning. What is Riot Platforms? How do they actually make money?
Okay, so at its core, Riot mines Bitcoin. That's the main engine. Think of it like digital gold mining, using a ton of computing power to validate transactions and get rewarded with new Bitcoin.
And that's where most of their revenue comes from.
Oh, yeah, big time. In the first quarter of 2025, Bitcoin mining brought in $142.9 million. That was like 88.5% of their total revenue right there.
And that total was what, $161.4 million for Q1? Gives you a sense of scale. How does that compare to, say, last year?
Well, for all of 2024, their total revenue was $376.7 million. You can see that Q1 number points towards, pretty significant growth.
But it's not just Bitcoin mining, right? You mentioned other segments.
It's exactly. They've got this engineering segment, too. That brought in $13.9 million in Q1 25. This part designs and builds specialized electrical gear for different industries.
And that got a boost recently.
Yeah, they bought a company called E4A Solutions back in December 2024, which added to that engineering side. Then there's a smaller other category, about $4.6 million in Q1.
So mining's the giant, but engineering adds a bit of, diversification. What are the actual products or services?
For mining, the product is the Bitcoin itself. They mined 1,530 Bitcoin just in Q1 this year.
Wow.
On the engineering side, it's custom electrical stuff, power distribution equipment, things like that. For data centers, power plants,
Okay.
And here's the really interesting bit, the shift. They're moving into building infrastructure for AI, artificial intelligence, and high-performance computing, or HPC. Basically, the power-hungry foundations needed for that stuff.
That's a major pivot. And they got out of hosting other people's miners recently, too, right? After the Rhodium deal.
Exactly. April 2025. Seems like they're really focusing now on mining their own Bitcoin and building out this AI HPC infrastructure potential.
Makes sense. Concentrate the resources. So how big are they in the mining world? What's their market position?
They're definitely one of the big players. Among the largest vertically integrated miners in North America, their hash rate, their total mining power, was a huge 33.7 exahashes per second at the end of Q1, up from 31.5 at the end of 24.
33.7 EHs. That's serious computing power. And their facilities.
Massive. That Corsicana facility they're building out, planned for 1 gigawatt of power capacity. 1 gigawatt.
Okay, that puts them right at the top tier.
For sure. And the market values them accordingly, market cap around $3.27 billion today. Plus, and this is important, they hold a lot of Bitcoin on their balance sheet.
How much?
As of March 31st, it was 19,223 Bitcoin, not pledged as collateral or anything, valued then at about $1.6 billion.
Wow. That's a massive digital treasury. Gives them options, I suppose.
Definitely gives them financial flexibility. But, it also means huge exposure if the Bitcoin price drops. Risk and reward right there.
So what's their big pitch, their value proposition? What are they telling the market they are?
Their official line is to be the world's leading Bitcoin-driven infrastructure platform. Kind of buzzwordy, but let's break it down.
Okay.
Pillars seem to be: 1, vertical integration, owning the engineering and the mining. 2, power strategy, especially in Texas, using things like power purchase agreements and demand response in the ERCOT grid.
Right. We'll need to talk more about that ERCOT angle.
Yeah. 3 is just sheer scale and efficiency from those huge sites. And 4, that diversification using their infrastructure know-how for AI and HPC.
So Bitcoin-driven is key. Mining is still central, but they want to leverage that infrastructure for more. And that grid stability point in Texas is interesting, too.
Right. They position themselves not just as energy users, but maybe participants helping the grid. So, bottom line, they mine Bitcoin and sell it. They design and sell electrical equipment. And they're building out for AI/HPC while exiting hosting.
Got it. Okay, that clarifies what Riot does. Now, let's zoom out a bit. What's happening in the industries they operate in? Bitcoin mining and AI/HPC.
Well, Bitcoin mining,
Yeah.
it's getting tougher. Mining difficulty keeps going up. Overall network hash rate climbs. I mean, you need more power, better machines just to keep up.
And the halvings don't help margins either.
Exactly. That April 2024 halving cut the block reward in half, puts immense pressure on miners to get bigger and find cheaper power. We're also seeing more institutional interest in Bitcoin and definitely more focus on ESG, the environmental side of mining.
And how does the AI and HPC market look?
That's just exploding, really.
Yeah.
Driven by all the demand for AI and machine learning. The catch, it needs massive amounts of computing power and energy.
Which plays right into the hands of companies who know how to build and run big power-hungry data centers, like Bitcoin miners.
Precisely. It's a natural fit infrastructure-wise. So you see miners like Riot looking at this and thinking, opportunity.
A strategic diversification. Okay, so who are Riot's main competitors in the mining space?
It's a crowded field. You've got other big public companies like Marathon Digital, that's MARA, and CleanSpark, CLSK. It's basically an arms race for hash rate and the most efficient new miners.
How do they stack up on hash rate, say, Q1 numbers?
Okay, so Riot reported that 33.7 EH is deployed. Marathon was talking about 54.3 EHs energized. And CleanSpark back in January had already passed 40 EHs. So Riot's big, but others are bigger right now.
And the crucial number cost to mine in Bitcoin, how do they compare there?
This gets a bit tricky. Riot said their Q1 cost, excluding depreciation and amortization, was about $43,808 per coin. Their net power cost was 3.4 cents per kilowatt hour.
Okay, and the others?
Well, Marathon reported an energy cost per Bitcoin of around $35,700, with power at their own sites costing 4 cents per kilowatt hour. CleanSpark reported a marginal cost around $34,000, with power at just over 4 cents per kilowatt hour.
Interesting. So Riot claims a lower power cost, 3.4 cents. But their overall cost to mine seems higher than Marathon's and CleanSpark's reported numbers.
Exactly. It raises questions, doesn't it?
It does. Is it less efficient hardware? Higher maintenance? Different accounting for other costs? It shows cheap power isn't the only thing that matters. Operational efficiency across the board is key.
Absolutely. Labor, upkeep, the actual miners they're running.
Yeah.
It all adds up. And we still need to talk about those potential tariffs on new miners, which could really shake things up.
Right. Let's park that for a moment, though. What about the regulatory side? What's the vibe in the U.S. right now for crypto and mining?
It feels like it's evolving, maybe moving towards more clarity at the federal level.
Yeah.
There's talk of actual frameworks, not just enforcement.
Any specific wins for miners?
Well, the SEC did clarify back in March that proof of work mining itself, what Bitcoin uses, isn't automatically a security. That removes one layer of uncertainty, potentially.
But it's not consistent everywhere, right?
Right.
State and local rules matter, especially for energy.
Totally. Texas is the big example. Its deregulated energy market attracted miners, offering potentially cheaper power, and those ERCOT demand response programs you mentioned where they power down and get credits.
But that's also drawn criticism, hasn't it, about using too much power?
Yes, definitely scrutiny there. And now, layer on top of that, these potential U.S. import tariffs on the mining machines themselves.
This seems really important. What exactly is being proposed?
Okay, so there's already a baseline 10% tariff. The big deal is a proposed extra tariff, maybe 24% to 36%, specifically on ASIC miners coming from places like Thailand, Malaysia, Indonesia.
So potentially 34% to 46% total tariff?
Could be. And these ASICs have a specific import code, HS8543.70.9960, that apparently doesn't get the same exemptions as general computer stuff. The date we're hearing for this potentially kicking in is July 8th, 2025.
Wow. So you might have the federal government saying crypto mining isn't a security, but then trade policy potentially slams the door with huge costs on the essential equipment. That's
It really is. Could seriously hurt U.S. miners' competitiveness if it goes through.
Okay, so given all that high costs, power needs, regulations, tariffs, what are the barriers to entry for someone wanting to start mining Bitcoin now? Does this help Riot?
The barriers are huge. And yeah, they generally favor the established guys like Riot. First, just the sheer capital needed for the machines and facilities is enormous.
Millions and millions.
Then securing cheap, reliable power is tough, complex deals, long commitments. You need economies of scale to compete. You need the tech know-how. Navigating regulations adds cost. And now these potential tariffs just makes it even harder for a new entrant in the U.S.
So the moat gets wider, maybe. Okay, fundamental question then. Does this whole Bitcoin mining industry have a long-term future, given Bitcoin's volatility, environmental questions, regulations, halvings?
That's the multi-billion-dollar question, isn't it? Its future is obviously tied to Bitcoin's adoption and price. But yeah, all those things you listed are real challenges.
But the diversification matters here.
I think it has to. Miners like Riot pivoting towards AI HPC, using that infrastructure for something else.
Yeah.
That could be key to long-term survival, making them less dependent just on Bitcoin. But those tariffs loom large over the core mining business. That's a serious threat.
Okay, makes sense. So let's focus back on Riot specifically. What are their competitive advantages? What makes them stand out?
Well, brand-wise, they're known. A leader in that vertically integrated mining space, NASDAQ listed, gives them credibility.
Though maybe some confusion with Riot Games, the video game company.
Yeah, got to keep those separate, distinct companies. Now, cost advantages. They push that low power cost hard, the 3.4 cents calor number. And the scale of places like Corsicana is meant to drive efficiency.
Plus the vertical integration, owning the engineering side.
Right, the idea is that helps control costs and development time. But again, remember that Q1 cost to mine number was higher than some others reported, so maybe the power advantage gets eaten up elsewhere. It's not totally clear.
Network effects. Not really applicable directly to them, right? More to Bitcoin itself.
Correct. They benefit from Bitcoin's network effect, but it's not their direct advantage over another miner in the same way.
And switching costs for customers.
Not really for Bitcoin sales, it's a commodity. Maybe some stickiness for their engineering clients if the systems are super custom, but hard to say. And irrelevant now for the hosting they exited.
So what are the really unique things? The hard-to-copy assets or skills?
Okay, number one is that massive infrastructure, Rockdale. The potential of Corsicana, that's hard to replicate. Two, the vertical integration model is fairly unique at their scale.
3 must be the power strategy in Irako.
Definitely. That active management, the demand response participation, that's a sophisticated capability. 4, their big Bitcoin treasury gives them financial firepower. And 5, developing those AI HPC capabilities off that massive power base at Corsicana, that's a unique strategic bet.
So boiling it down, why is Riot hard to copy?
It's a combo, I think. Huge capital needs up front. Deep expertise in power markets, especially tricky ones like ERCOT. The operational skill to run these giant farms efficiently, they claim over 88% uptime, which is pretty good.
The vertical integration adds complexity, too.
Right, plus navigating regulations.
Yeah.
And just having that existing scale, that deployed hash rate, it's a high wall for newcomers to climb.
All right. Let's shift gears now and look at the people running the show, the management. How's the leadership look?
CEO is Jason Less. Been CEO since early 2021, but with Riot since 2017. His background's interesting. Deep into Bitcoin since 2013, mining protocols, even AI engineering before Riot.
And he was a pro poker player.
Yeah, apparently. Says it helped with strategic thinking, risk management. Make of that what you will.
Okay. So under his leadership, what have been the big wins and challenges?
Wins. Definitely raised a lot of capital, over $1.5 billion, massively scaled up operations, made some key acquisitions, got record revenues. Challenges, well, profitability's been inconsistent. That big Q1 loss, even though mostly non-cash from Bitcoin's value dropping on the books, still looks bad. So growth, yes. Yeah. Consistent profit independent of Bitcoin's price, still a work in progress.
What about the rest of the team? Average tenure?
Management team tenure is around 3.1 years on average. The board's been around longer, average 7 years. You've got the usual C-suite roles filled, CFO, COO, strategy guys. They've clearly shown they can raise money and build big things.
How have they handled crises? We know crypto markets and Texas weather can throw curveballs.
Yeah, they had weather damage at Rockdale back in late 2022. Seemed to manage the recovery. But the more interesting response is how they handle Texas energy events.
The demand response thing again?
Exactly. They actively power down during peak demand, help the grid, and earn millions in power credits from ERCOT. It shows they can be nimble and use their energy load strategically. In terms of crypto volatility, their main strategy seems to have been just build bigger, integrate more, keep expanding hash rate.
That ERCOT strategy is definitely unique. How open are they about things like that? How's their transparency with investors?
They do communicate a lot. Monthly production updates, quarterly calls with presentations and Q&A, SEC filings. They tick the boxes. They even list transparency as a core value.
But is the communication clear given how complex this all is? Bitcoin volatility, power deals, the AI pivot?
That's the key question. They talk a lot, and they do explain the earcast stuff coactively. But weaving together how all these complex pieces really interact financially, an investor still needs to dig deep to fully grasp it. Clarity could always be better on the interconnections.
What about public perception? Mining uses a ton of energy that attracts criticism. How's Riot viewed?
Yeah, they definitely get heat for that. The Rockdale facility's energy use has been a target for environmental groups. Riot counters by talking about renewable energy use and their grid support via demand response.
But that demand response itself is controversial, right? Profiting when the grid is stressed.
Exactly. Some critics frame it as profiting from energy crises, so it's a double-edged sword reputationally. They say they're helping grid stability, others see it differently. And just to be clear again, this is Riot Platforms, the miner, not Riot Games, the game developer with its own separate issues.
Right, important distinction. So overall assessment of management, honest, capable, shareholder-focused.
That's nuanced, honest. They follow disclosure rules, claim transparency. But the complexity means you got to verify. Capable, yes, in raising capital, scaling, making deals. But consistent profit is the missing piece, and the AI pivot is a big if on execution.
Shareholder-focused.
They say they are. Using Bitcoin sales recently to fund growth instead of issuing more stock is a potentially good sign. The CEO has a big stake. But that CEO pay package for 2024 was pretty large, especially given recent losses. That might raise eyebrows.
And the new board members.
Right, getting those new independent directors with AI/HPC expertise, with input from Starboard Value, the activist investor, that looks like a move responsive to shareholder interests, pushing that strategic diversification. Okay, let's follow the money, capital allocation. Where's Riot putting its cash?
Primarily, it's going right back into the core business, expanding mining. Huge spending on building out Corsicana, buying newer, more efficient miners, and beefing up their engineering side, like buying E4A solutions. It's all about more hash power, more efficiency.
And they've used acquisitions quite a bit for growth, too.
Oh, yeah. Windstone gave them the Rockdale site, ESS Metron boosted engineering, block mining got them into Kentucky, E4A added more engineering muscle, and that rhodium deal seemed pretty clever.
Absolutely. Taking over those assets at Rockdale, let them ditch a bad hosting contract, grab more self-mining capacity, and settle some lawsuits. That looks like a really smart value-adding move. What about giving cash back to shareholders? Buybacks. Dividends.
Doesn't look like any recent buybacks. Pretty normal for a growth company in a capital-heavy field like mining. They're plowing money back into expansion.
Dividends.
Nope, none currently. Last one was way back in 2017 before they went all in on Bitcoin mining. Again, standard for their growth phase and industry.
So how well are they actually using all this invested capital? What do metrics like return on invested capital, ROIC, tell us?
Uh-oh. This is where it looks less rosy right now. Reported ROIC is negative, around minus 11%. Return on equity, ROE, also negative, maybe minus 16%.
Not good. That's so low.
Well, partly the recent net losses. Partly huge investments like Corsicana that aren't fully up and running yet. And holding billions in Bitcoin on the balance sheet complicates things too. It's an asset, but doesn't generate income in the traditional ROIC calculation sense. They need sustained operational profits to turn this around. Management sometimes mentions a Bitcoin yield metric, but that's not standard accounting.
So summing up capital allocation, are they using money effectively to grow shareholder value? Sounds like maybe.
It's definitely mixed. They're great at raising money and building big things. They hold a ton of Bitcoin. Some acquisitions, like Rhodium, look smart. The AI/HPC pivot is forward-thinking, but it hasn't consistently translated into shareholder value beyond just riding the Bitcoin wave. Negative ROIC is a red flag. The stock moves with Bitcoin. Stock-based compensation is a factor.
The recent shift to selling Bitcoin to fund growth is interesting, though.
Yeah, limiting dilution is potentially positive. But long-term, they have to show sustained profits and get that ROIC moving in the right direction to prove they're really allocating capital effectively.
Okay, let's dig into the financials themselves. The nitty-gritty numbers, key metrics investors should watch.
All right. Market cap today, around $3.27 billion. PE ratio, well, it's negative, minus 7.79 on a trailing 12-month basis. That's because of the recent losses, especially that big one in Q1 2025 of $296.4 million.
Even though they were profitable for the full year 2024.
Right. Full year 2024 showed net income of $109.4 million.
Right.
But the Q1 25 loss flipped the TTM PE negative, shows how volatile earnings can be.
But revenue growth looks strong.
Very strong. Q1 25 revenue, $161.4 million. That's up over 100% year over year and up 13% just from the previous quarter. Full year 24 revenue was up 34% too. So top line growth is definitely happening. More Bitcoin mined, higher prices sometimes, plus that engineering segment contributing more.
Okay, but what about profit margins? That Q1 loss must have hammered the net margin.
It did. Gross profit margin in Q1 was actually decent, 45.6%. But yeah, the net loss meant a net margin of negative 183.6%, mostly due to those non-cash write-downs on their Bitcoin and securities holdings when prices fell.
So the underlying operation might be making a gross profit, but accounting rules for digital assets can swing the net income wildly.
Exactly. Full year 2024 net margin was positive 29%. Huge difference. Really highlights the Bitcoin price impact on the bottom line.
What about debt? Are they leveraged up?
Debt to equity seems moderate, somewhere around 0.19 to 0.26 based on Q1 numbers. Total liabilities were about $439 million against equity of $2.34 billion. So not dangerously high leverage right now.
Free cash flow.
Yeah.
Always critical. Are they generating cash?
Nope. Currently negative free cash flow. Estimates for Q1 put it around negative $65 million. Full year 2024 was also substantially negative.
Typical for growth companies investing heavily.
Yes, but it's not sustainable forever. They need those investments to start generating positive cash flow eventually. It's a cash burn situation for now.
And price to book ratio. What's that tell us?
It's hovering around 1.05 to 1.11. Since they have significant physical assets, facilities, and the digital assets, Bitcoin, it gives you a sense of market value relative to book value. Close to 1 means market value is roughly in line with the balance sheet value.
Okay, so summing up financial health.
Yeah.
Profitable sometimes, like 2024, but big loss in Q1 25, mainly from non-cash items. Gross profit is positive. Balance sheet looks pretty strong, lots of assets, including that Bitcoin stash, moderate debt. But that Bitcoin price exposure is the big vulnerability.
That nails it. Now let's look at stability. How consistent have earnings been over, say, the last 5-10 years?
Not consistent at all. Highly volatile. Profit in 24, losses in 23, 22, 21, and Q1 25. There was even some confusion over the Q1 24 numbers initially. It just jumps around based on Bitcoin price, halving impacts, energy costs, those non-cash charges. Very choppy.
And dividends, reliable income stream.
Definitely not. No dividends currently. None since 2017. They're reinvesting everything into growth. Not a dividend play.
How are they managing the debt they do have? You mentioned convertible notes earlier.
Right. They issued those notes due 2030, back in December 24, raised a lot of cash, low interest rate, which is good, but they can convert to stock later, meaning potential dilution for existing shareholders.
How much debt overall?
Notes payable were $258.4 million in Q1. Plus, they have a newer Bitcoin-backed loan facility with Coinbase. Debt levels seem okay for now, but yeah, the convertibles add that dilution risk, and servicing any debt depends on generating those volatile profits.
What about managing day-to-day cash flow? Working capital?
Working capital looks strong in Q1, though down a bit from year-end 24, probably used cash for operations and investing. Current ratio is healthy, suggesting they can cover short-term bills. And that huge Bitcoin holding gives them extra flexibility. Selling some Bitcoin each month now also helps manage cash flow.
Okay, so stability summary, earnings, definitely volatile, debt, not excessive now, but the convertible nature and reliance on volatile profits mean you've got to watch it.
Okay, let's shift to how the market feels about Riot. What's the sentiment out there?
It's complex, and honestly, it's super tied to Bitcoin's price. The stock's got a high beta, 4.6, meaning it swings way more than the overall market, usually following Bitcoin.
So investors are basically trading it as a proxy for Bitcoin, maybe with some leverage.
Largely, yeah. There's interest in the growth story, the AI/HPC angle for sure, but also real concerns about the lack of consistent profit, the cash burn.
What about that activist investor, Starboard Value? How did the market react to them getting involved?
Generally positive. Activists often push for changes to unlock value, so the markets seem to like seeing them take a stake and influence the board appointments. Oh, and interestingly, one report mentioned negative sentiment among Indian investors recently, but that's just one data point.
What are the professional analysts saying? Price targets, buy, sell, hold.
Generally positive outlook from analysts. The consensus is a buy rating, lots of strong buys and buys. The average price target significantly higher than where the stock is now, like $18.77 average target versus the current $9.15. So analysts see a lot of potential upside. Of course, analyst targets are just one input.
All right, got to take them with a grain of salt. Yeah. What news has been moving the stock lately?
Well, earnings are always big. Q1 released record revenue, but that big loss caused volatility. Monthly production updates matter. Finishing the rhodium acquisition was seen as good news.
And the tariff talk.
Yeah, any news or even rumors about those tariffs definitely creates uncertainty and puts pressure on the stock. Starboard getting involved was a positive catalyst. And underlying all of it, Bitcoin's price moves are probably the biggest daily driver.
What about short interest? People betting against the stock. Options activity.
Short interest is high, really high. Like 22–25% of the float is shorted, means a lot of people are betting the price will go down.
Wow.
And the options market is very active, with high implied volatility, meaning traders expect big price swings. It all just points to a very speculative stock with sharply divided opinions on its future.
Okay, let's look inside the company now. Who actually owns Riot? Ownership structure.
Institutions own a big chunk. We're talking maybe 64% or so. Big names like Vanguard, BlackRock are major holders.
In Starboard Value, the activist.
Yep, they have a significant stake too, around 3.5%. Having lots of institutions can provide stability and liquidity, but it also means management has to listen to them. And an activist like Starboard can actively push for changes, as we saw with the board.
What about insiders? Management, board members? How much do they own? Any recent trades?
CEO Jason Les owns a decent chunk, over 2%, worth quite a bit. Overall, insider ownership is around 7%. There has been recent activity. A new director bought shares, which usually looks good, but also some selling.
Yeah, some directors, including the CEO, sold some shares earlier in the year. People sell for lots of reasons, but it's something investors watch.
The director purchase is probably the more positive signal there. Is the ownership concentrated? Like, do a few big funds control things?
It's moderately concentrated among those top institutions.
Yeah.
No single one has majority control, but Vanguard, BlackRock, Starboard, they have clout. It can bring stability, but also pressure for short-term performance.
And how does this ownership, especially Starboard's involvement, impact corporate governance? It's clearly had an impact already. The board expanded recently, adding 3 new independent directors with AI, HPC, and data center experience. That happened with Starboard's input.
So Starboard is pushing that AI HPC strategy via the board.
Seems very likely. The company talks about responsible governance, risk management, has the usual committees, holds annual meetings, has a code of ethics. But Starboard's arrival definitely shook things up and seems to have accelerated the focus on diversification and maybe brought more external expertise onto the board.
Okay, let's pull everything together now with a SWOT analysis. Strengths, weaknesses, opportunities, threats. Let's start with strengths.
Okay, strengths. Their sheer scale in Bitcoin mining. That strategic power management, especially in ERCOT, the vertical integration model, holding a lot of Bitcoin. A relatively strong balance sheet and access to capital, experienced management in terms of growth and funding, and that big potential diversification into AI HPC.
And weaknesses, the internal downsides.
Biggest one, huge dependence on Bitcoin's price. Negative free cash flow and ROIC right now. That Q1 cost to mine was surprisingly high. Earnings volatility due to those non-cash items is massive. Execution risk on huge projects like Corsicana, the impact of Bitcoin halving is pressuring margins, and just the overall complexity of running this kind of business.
Opportunities. What could go right for them?
Well, obviously, Bitcoin price going way up is the biggest one. Successfully pivoting and scaling the AI HPC business would be huge. More smart M&A deals could add value, improving operational efficiency, lowering that cost to mine, finding even better power deals, more institutional adoption of Bitcoin generally, and maybe some favorable regulations down the line.
And finally, threats.
Yeah.
The external dangers.
Bitcoin price crashing is threat number 1. More competition globally driving down mining profits. Regulatory risks, new rules, crackdowns, energy price spikes or availability issues. Competition in AI HPC too, not just mining. Their tech becoming obsolete. Supply chain problems getting miners. Cybersecurity attacks. And continued environmental or community pushback.
And we have to specifically call out those U.S. tariffs. Let's detail that thread again.
Right. This is critical. The potential for an additional 36% tariff on top of the existing 10%, specifically targeting ASIC miners, HS code 8543.70.9960, effective maybe July 8th, 2025. This isn't general computer gear getting an exemption.
What could the likely impact?
Huge increase in the cost of new miners, their main capital expense, makes U.S. miners less competitive globally, squeezes margins, forces strategic shifts.
Like what?
Maybe they stockpile miners beforehand if they can, focus on sweating existing assets longer, accelerate that AI HPC diversification even faster to rely less on new miner imports. Look for M&A targets with newer fleets already in place, maybe even explore long-shot domestic manufacturing. It fundamentally changes the economics of expanding their core mining business in the U.S. if these tariffs hit hard. Big threat.
Wow. Okay, so bringing this all home, Riot Platforms. It's definitely a complex investment case, isn't it?
It really is. You've got this major North American Bitcoin miner, clear strengths in scale and power strategy, and this really interesting, potentially massive opportunity in AI HPC. But huge challenges too. That deep reliance on Bitcoin's price, the current lack of profitability and negative cash flow, and this very serious looming threat from U.S. tariffs that could hit their core business hard.
So for a traditional value investor looking for consistent profits, positive cash flow, good ROIC, Riot doesn't really check those boxes right now.
Not currently, no. However, there is potential value in their physical infrastructure. That massive Bitcoin treasury adds another dimension, and the influence of an activist like Starboard trying to unlock value makes it intriguing.
A lot of uncertainty, though.
Yeah.
Bitcoin's price, executing the AI plan, and especially those tariffs.
Those are the key variables. Their future really hinges on navigating Bitcoin's cycles, delivering on these big projects, managing costs effectively if those tariffs land, and just generally adapting fast in two very dynamic industries, crypto and AI infrastructure. It's a high-stakes game.
Definitely a lot to digest there. Well, if you found this deep dive helpful, we'd really appreciate it if you'd hit the like button and subscribe to the Stock Analytics AI YouTube channel.
And hey, for our members, that's the Euro 4.9 a month level. Remember, you can drop a stock ticker in the comments. We prioritize those requests for future deep dives or for analyses right after earnings calls.
Absolutely. Now, just the standard reminders.
Right. Importantly, none of this was financial advice. We're doing this for information and education only. Investing has risks. Please do your own homework. Talk to a qualified financial advisor before making any decisions.
And we should mention, AI tools may have helped in researching and preparing this content. Information can change fast, accuracy isn't guaranteed, and past performance definitely doesn't predict future results.
You can find links to the sources we use down in the description if you want to dig into any of this further yourself.
So as we wrap up, maybe a final thought to leave you with.
Yeah, thinking about Riot and the whole sector. With regulators watching closely and costs potentially soaring because of things like tariffs, you have to wonder, how sustainable is that traditional large-scale Bitcoin mining model in the long run?
And maybe, can these companies that got really good at one specific thing, mining Bitcoin, truly pivot successfully into a different ballgame like AI and high-performance computing? It requires different skills, different markets.
It's a fascinating strategic challenge to watch unfold. Definitely something to keep pondering.
We'll be back soon with another deep dive. Make sure you subscribe to Stock Analytics AI on YouTube so you don't miss it.
Thanks for tuning in, and stay curious.